Good morning. Welcome back. Forex Focus on Tasty Live. It's Thursday, April 10th.
It is. The month's moving
And
fast, my friend.
what a week we've had.
How about it?
Man, good stuff. Now we can smile.
There you go. Look at him. Oh, he is a morning person. Look at him.
Good to go.
We're going to have to give you the Cook County shower with the cold hose every morning. Yeah, it's been quite a wild ride, hasn't it?
Man, yeah. You got any money left?
Just enough.
Okay. Reprieve.
You were out there like a demon, in and out of so many different things yesterday.
Yeah, I was poking around. Wasn't able to catch, all 12% of the NASDAQ rally, but
Again, who?
giddy up. Good. I will say it's a good thing I was limiting myself.
Honestly, there's
Would have tried to call the 8, the 10%. I would have faded all of them. Wouldn't have worked.
And, before the U.S. equities just a little bit softer this morning, but that's after trading the NASDAQ another 150 points higher in those, first 2 hours after we reopened at 5 o'clock in the evening, along with what was interesting is they slammed the yen, they slammed the Swiss, the safe haven things that had traded up to almost 70 cents. We're down to rock bottom levels in dollar yen. Bid really strong, and the reversal today is really speaks to. I mean, equities aren't like back down.
Right.
5%, 8%. They haven't given back 3/4 of that upside move, but the rally we saw in dollar yen and dollar Swiss, and even a little bit of selling in pound and euro, came right back, pretty strong.
And
one of the things we talked about yesterday, again, Wednesdays are spa days for Glenn, so he and you know what? Maybe you're doing it right because you look good.
Thank you.
I mean,
it's all my vitamin C showers.
Yeah, I'm a little worse for wear, but interesting to see that some of the things we looked at were some of that dichotomy between commodity currencies and
traditional
the main G7. We looked at, I think yesterday I looked at Euro Aussie, which had been at an absolutely amazing extreme. It's interesting that, and this is why you saw yen collapse, Aussie and Canada and Kiwi skyrocket on the news that the tariffs are suspended. Now, you're seeing Euro and Sterling up today, and it's like, well, why didn't they rally with Aussie, Canada, and Kiwi? And part of the reason is these crosses, these non-dollar crosses we highlight, sometimes drive the underlyings. And I think what we're seeing is, remember that chart in Euro Aussie was just, I mean, we were 20 handles in 3 days, 20 big figures. As some of those get realigned from some of the moves, from 170 to 185. As some of that gets realigned, that plays through. Yes, there's Aussie buying, but if you're buying Euro Aussie and others are buying Euro Aussie, you're seeing that Euro getting. I'm sorry, if you're selling Euro Aussie.
Some of that pressure plays through.
Some of that pressure plays through on Euro USD and Aussie USD. So you're seeing a little bit of that. That was where you didn't see the dollar just get sold on everything.
Right.
You saw it selectively get sold. And part of it was the realignment of some of these crosses driving that. And now we're seeing Aussie Canada still up again today, but we're seeing Sterling up 122 pips, Euro up nowhere near as much, but again, bouncing back nicely.
Let's pull up the platform.
Right.
It's all there for us. Yeah.
And what's surprising is that Bish is buying in dollar yen yesterday.
I mean, what a range there.
Yeah.
We pull up dollar yen here. Here we're looking at the hourly chart.
Right.
And this is one, if you're watching real time,
3.5 big figures.
yeah,
Yeah.
you're watching this and you're seeing, myself, I have 6 of the major pairs, major dollar pairs up at once. And you're seeing, like you called out, what's getting hit, what's not. This dollar yen was one of the only ones that kept moving through highs.
Right.
You got some pullback in Aussie, even Swiss franc a little bit was starting to lag. Dollar yen kept going,
Right.
hitting 148, finally finding some pullback there, and then this morning all of it gone.
All of
right,
it gone.
right back to where
Yeah.
we were. And yeah, while not surprising to see intraday moves taken out in currency markets, especially when you have an intraday move of 2%, getting that all taken out in a matter of 12 hours is surprising.
And I think you hit on a great point. We're not talking about giving back half of a normal day's range, which I believe in the yen we had
80.
estimated around 85 pips.
Yeah.
So we're not talking about this candle, up candle was 85 pips or 100, and we've given back 50 of it. We are talking about this candle is
That's 200.
300 pips.
That's another 40.
Yeah.
That's another 50. Yeah.
Yeah, 300 pips from 145 to 148, and now we've given back 275 pips. Those are, by any stretch of the imagination, outsized amount. So, first thought looking at that, the one standard deviation 30-day math, isn't that helpful right now?
Not that helpful, and especially because those are around a 24-hour period. Where are you picking from here? You're getting you're kind of in the middle of the range. If you're looking at this 12-hour move, you've definitely exhausted the range to the downside.
Right.
But yeah, where does it really settle for the U.S. session?
And I think this is a case where that tool we like to use around probabilities is not very useful for us for static delta or just directional trading right now. So the first thing you do is lower your size. Cut your size down a little bit. You pick it. I mean, but you were getting movement and opportunity. It's accepting what the market's giving. Now, that doesn't mean we dispense with one standard deviations. These are abnormal times.
Right.
So it's not, I can't lean on because this was an example of if I leaned on the 2 standard deviation move, it would have been 160 pips. I would have still gotten run over.
Yeah.
Both ways.
Yeah. And maybe there's still some merit perhaps in using it as a profit taking tool or stop loss, more of managing expectations once you have the trade,
Yeah.
but using it for trade entry a lot harder now.
Yeah, absolutely. But the good news is that these runs and vol like this, which is basic expansion and ranges, the elasticity.
Well, look at all these daily charts.
It is not going to stay there forever. We're going to normalize at some point, susceptible to, again, every tweet, which will create challenges for us. Challenges and opportunities. So I think we don't throw it out of the toolbox, but we're just mindful it is not as useful a tool as it tends to be. So you widen out your expectations. What does that mean? You'll miss some of the trades you want. But you'll also start to think about, and this is what's difficult. It's great when we talk a lot about, okay, what that tool helps us do is determine a good entry level. And then the two most important decisions that come from a good entry level are, where am I getting out when I'm wrong? Where am I getting out when I'm right? And if you can't make those, you should still be making those decisions now around every trade and be thinking about that. The one thing that will be different is if you're going to do that and engage, when you're wrong and you're going to have to pull the trigger on that, you're not going to wait an hour or 2 hours to be wrong. You could be waiting a minute to be wrong.
Exactly.
So,
and wrong in a big way, a much bigger way than you'd expect it.
Right. And so it speaks to that we want to be able to still, the fact that you put on what you felt, say a short here at a value level, and the market continued to go. It went quickly. You would have had to manage that trade pretty quickly,
Right.
and you would have probably had to reach to get it. Time isn't the function. Whether you manage it, as long as you set those thresholds, if it takes a day to manage or a minute to manage, you still manage. And
Right.
that's both good and bad. I mean, sometimes you'll catch them just right and do that. But you shouldn't say, well, it moves so fast, so quickly, I should give it more rope. Don't do that. Stick to your mechanics. If you do that, you're going to find that, yes, you're going to have these losses that come, like, wow, that was fast.
Right.
But
you're
you're
on to the
still
next.
back. You're on to the next one. You're not overly biased in one direction, like, oh, being short cost me so much money, I can't be long because
yeah.
I'll kill myself.
And sounds much easier in theory,
It sure
because
does.
it gets emotional real fast. But great call out. And one thing you said that's interesting to me is when you're looking at a market like US dollar, Japanese yen, here we're seeing expanded ranges here on the daily chart. And you're right, we can only do static delta directional trades
Right.
here. And so that makes it tough when you're talking about standard deviations. But what is an interesting wrinkle to me is you take a market like this, which is at perhaps a low for the past 8 months, but not if you're not as certain here. Looking at yen crosses right now is pretty interesting as well. And so if you wanted to take any of that, keep maybe bound the Japanese yen exposure
Yep.
on maybe two sides, looking, and this speaks again to lowering your trade size, and kind of sprinkling markets that are correlated, can kind of synthetically give you maybe a lower delta on your yen exposure, and not to say that this works out exactly right, and these are all evolving markets, but something like this euro yen has been interesting, as well as
And great call on euro yen.
pound yen.
Yes.
I mean, yesterday, this now with the pullback gives you a different story. But we were looking at it yesterday. If this candle was red and you're looking at it below 186, you're looking like that's a major price extreme, with a lot of momentum. But now a different story.
Reverted back. And I think, the larger currency cross traded is dollar euro USD. Dollar yen a close second. The largest non-dollar trade cross that's traded in terms of notionally in the cash markets is this.
Yep.
So there is good liquidity. It's a deep market. It's a different opportunity. And it's constructing varied set of outcomes. And what I like about being able to trade the crosses as crosses, the only other way you can trade this, you can't do it through ETFs. You can try to use futures to construct them. It's clumsy, it's big, and you get margin on both sides. So trying to do euro yen, the weightings are always off, and you've got tail risk, which means you end up with more euro than you do yen, and it's cumbersome.
And the sizing, especially, is tough
And it does.
large.
And when if you build that spread and then you want to trade euro because you want to get engaged in it, your positions start to reflect the fact that, wait, what happened to my euro yen? It's not put together anymore.
gets
I'm
cloudy,
taking it apart. I'm putting it together because I'm just scalping euros. What I love about this is if I have an opinion in one of these non-dollar crosses, I can put it on, I can scale orders into it and everything, take advantage of what I think is interesting movement. Then I can go back to trading euro or dollar yen. And this is going to sit undisturbed,
Right.
giving me some diversification, a little smaller beta, and a different set of outcomes. That's great. That's what we look for when we want to engage with product. So I am not suggesting you run down the rabbit hole of Turkish lira Thai baht. We're not going to crazy town with crosses. Yes, we've got 80 of them, but
Right.
there's more than enough opportunity. in the majors and the top five non-dollar crosses out there, but there's some really interesting. Again, Aussie yen is another one we can take a look at. Big moves there too.
Huge. Oh man.
Yeah.
4.6%.
Yeah.
There you go.
So, these are big outsized moves that are very different than just trading the underlying. This one in particular has a lot of elasticity to it. And I mean, some people say that, and I don't know if it holds or not, that the non-dollar crosses have more of a mean reverting aspect to them.
Interesting.
But if I'm living in Japan, Euro USD is a non-domestic cross. That should revert more. And I don't know if it necessarily does. I think what this does is give you a very easy way to express additional opinions with a bias without having to assemble, disassemble, and very easily track. That's powerful when you talk about next level diversification, even within the FX space.
Agreed.
So what do you have for us today?
I got some slides today.
Fantastic.
Want to get into some
Let's
slides.
get into it.
Another storyline we got here. If we can jump over to the slides, my friends. Another evolving storyline that's affecting everything. Maybe is even behind the
new storyline.
Yeah, maybe behind all of the reprieve we've gotten, but definitely in these dollar markets, it's been an evolving correlation between the Treasury market and the U.S. dollar. So let's get into it. What do bonds and U.S. dollars look like together in theory? And this is kind of more of a base case, is that traditionally you'd think rising Treasury yields, so falling bond prices, and the interest rate landscape that plays across the curve, set from the Federal Reserve all the way out to the 30-year, all move pretty similarly. And you'd think rising yields would lead to dollar appreciation because those yields are attractive. That's how the free-flowing bond market works. Once a yield is high enough to be attractive, the bond is purchased, and so that attractiveness leads to kind of flows into dollar-denominated assets.
Right.
And when you're talking about holding dollars in spot FX markets or in other markets, you're actually holding those dollars, you are generating that yield.
Right.
And that plays through significantly in currency pairs like dollar yen, where the interest rate differential is of a substantial size, and so borrowing one currency at a much lower interest rate overnight and holding the higher yield currency like a US dollar can generate, in theory, some passive returns via the popular carry trade strategy.
Right.
So here on the right, we've got the 3-month correlation between the 10-year note futures and the Japanese yen futures, which you can also in turn interpret as the yield on the 10-year and the dollar yen. Okay. So as the 10-year yield goes up, you're seeing a pretty high correlation to strength in dollar yen.
Very interesting.
So this is the base case, right? Nothing.
And the logic behind the confirmation of the logic behind the correlation.
Right.
That yields play a role in determining currency pair directions.
What's different now? Now we're looking. You've been looking, and yesterday you called out on the show appropriately that we saw a bit of a correlation breakdown with how treasuries were moving and the price action in dollar yen, not really playing out how we thought it. Right. How it has been and how maybe you thought it should. But a lot of interesting storylines in the bond market recently, and on the heels of all the macroeconomic conditions, all the trade wars, U.S. assets now kind of were moving similarly together as there was a bigger U.S. risk to all assets like the dollar and the bond market.
Right.
And so that would lead we saw low demand for bonds, and that because the bond prices are directly related to yields. That raises yields, but doesn't necessarily bolster demand for the U.S. dollar, because if there's low demand for bonds, maybe there's low demand for dollar-denominated assets as a whole.
And I think you hit on a lot of great points there. The idea, again, it was rumored the Chinese were, because while ZB, the long end bonds, were getting crushed from 122 to 120 to 118 to 116, 114, 112. Think about that. That's 10 handles. I don't remember the last time bonds have moved 10 handles. Even pandemic-wise, I don't think we moved 10 handles. It was rumored this was the Chinese taking some of their treasury holdings and just sending a message to the U.S. I also heard later in the day it was Japanese pension plans who hold a lot of U.S. bonds. We don't know. It's all
or this
third party.
The basis trade strategy unwinding.
Unwinding, right. It could have, would have. What it was, and while that pounding was taking place, the 2-year notes were actually railing. So this was very specific to one dislocated part of the Treasury yield curve. And when it breaks like that, it doesn't become a useful indicator for us at the moment. So but the first side you look at, 75% correlation. I want to be all around that in terms of helping me to decide on the direction I want to take in dollar yen. Is it your only thing? If yields are up, I'm long dollar yen? No. But if you see the right setup and you get confirmation from the signals you like, either, again, one standard deviation daily moves, U.S. rates, and then this is, again, given Japanese rates really haven't. They're on trajectory higher, but from a very low level. So I think this is really interesting stuff, but it does speak to when other things break that market, it becomes a less reliable indicator for us.
And you're absolutely right, because when you take a look at, when you try and wrap your head around what's moving the U.S. dollar, what a complicated question. Because you have, as we're looking at on the right, you have all these country-specific pairs that we can weight to get kind of a gauge on dollar strength as a whole. But we have a lot of factors impacting this U.S. dollar. If you zoom out on the macroeconomic landscape right now, you'd think, we're coming off roaring inflation, coming off a lot of growth. So slowing growth would impact kind of the forward-looking outlook on the U.S. economy. And that might lead to a slowdown in dollar demand, kind of regardless of what Treasury yields are necessarily doing, because interest rates would be coming down from the Fed. But then you have this trade policy wrinkle where, one, that leads to a lot of country-specific relative strength dynamics, like we saw earlier this year with USD CAD. I mean, that has nothing to do with overall dollar strength, because it's just two countries jockeying back and forth on trade, who's going to come out on top. But you also have, this trade policy from the Fed. They're saying could raise inflation, and then what does the Fed do? You get kind of, maybe we get into stagflation. Who knows? But not necessarily speaking to rates coming down as quickly. So, all is to say, bond prices and dollar prices, while related, a lot more impacting this dollar than just...
Absolutely. And I think what we're not saying is that, Pete, taking away some of the tools you suggested I use. One standard deviation daily ranges aren't working because they're blowing through them. Correlations to treasuries and yen was something that worked. It's not working right now. So what do I do? Sit on the sidelines? Absolutely not. You're mindful that the tools and the things we use to base decisions on all help us determine levels of value, and most importantly, where we get out when we're wrong and where we get out when we're right. That decision doesn't change. What we do is we adjust it in periods when some of the inputs we use are more challenged. It doesn't mean you stop trading. What you do is, again, you get smaller, you stay engaged, look at the entire landscape.
Exactly.
And one of the things that is hard, and I know this from a guy who started and spent his first 5 years just trading one thing, D-marks. I just stood in that pit, traded it every day. And then, because the yen pit was next to me, all of a sudden I was trading some yen. And you get to a point then you're managing a book of 15, 20, 25 underlines. And one of the things that's hard is when you start to expand that, it's all good when everything's moving and normal. But when stuff starts to rip, it's like, oh my God, what do I have on? What's going on?
Exactly.
By staying smaller, you can start that journey of a diversification and start to look at different things with different extremes. There is still so much opportunity out there right now. Just be mindful of again, some of the inputs we've used, yes, they're dynamic in how valuable they are in terms of context, but in terms of movement, we're getting exactly what an FX trader wants, back and forth.
Yep.
How we take advantage of that is up to us and our biases, but there's lots of opportunity, but it never takes us away from where we determine where we get in and where we get out. So keep that in mind, and you're going to be in good shape. It seems like a wild ride. It is a wild ride, but if you keep those contexts, you're going to be along for a great ride. So, but let's wrap it up there. Glenn, this was great context. Coming up next, Tom, Tony, and Vanessa. And we'll see you back here tomorrow for the latest edition of Forex Focus. Have a great day.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free?